Hello everyone. We are from Group 5. We are going to present our integrated case from Chapter 11. My name is Alistair, and there is Asri, Rostian, and Wisnu. So, the case is about Coleman Technologies. It is considering a major expansion program that has been proposed by a company's information technology group. Before proceeding with the expansion, and the company must estimate its cost of capital. So we are playing the role of Jerry Lehman's assistant, the financial vice president. So our first task is to estimate Coleman's cost of capital, and Lehman have provided us with the following data. So he thinks it may be relevant to our task. So the data is the firm tax rate is 40%. The current price of Coleman's 12% coupon, semi-annual payment, and non-callable with 15 years remaining to maturity is $1,153,000. Coleman does not use short-term interest-bearing debt on a permanent basis, and new bonds will be privately placed with no flotation cost. The third is the current price of the firm is 10% with $100 per value quarterly dividend, and perpetual preferred stock is $111. Colesman common stock is currently selling for $50 per share. Its last dividend was $4, and dividends are expected to grow at constant rate of 5% in the foreseeable future. Colesman beta is 1.2, and the yield of T-bond is 7%, and the market risk premium is estimated to be 6% for the bond yield plus risk premium approach. The firm uses risk premium of 4%. And the last is Coleman's target capital structure is 30% debt and 10% preferred stock and 60% common equity. So the first question would be question A. Question A asks what source of capital should be included when you estimate Coleman's WACC. So WACC formula is percentage of debt multiplied by after tax cost of debt plus percentage of preferred stock multiplied by cost of preferred stock plus percentage of common equity multiplied by the common cost equity. So from the formula, we can know the source of capital would be the debts, and second is the preferred stock, and the third is the common cost of equity. So the second question would be the component of cost figured on should the component of cost be figured on before tax or after tax basis. So it should be after tax since the formula included 1 minus t to give it some weight, and after tax basis only applicable to cost of debt since the interest income can be deduction of taxable income. So the formula of cost of debt will be RD 1 minus T. The preferred stock and common stock will be calculated as before tax basis. And the third questions of A should the historical or embedded cost or new marginal cost included. So it will be marginal since WACC is more future oriented. So the capital raise will be fitted into the new or desired capital structure. And second, it will be decide to whether to approve or reject and to finance new projects. So from the purpose of the capital, it will be future oriented, not the past oriented. So it will be new or marginal cost. And questions B, asking what is the market interest rate on Coleman's debt and its component of cost of debt? So we believe that the interest rate is the yield to maturity. So we can see the previous chapter of bond valuation. So unfortunately, it would be too long in the slide if we use algebra. So instead, we use financial calculator to solve for the interest rate. The input the calculator would be the future value is 1,000, present value 1,153.72, the price of the bond. The payment should be 60 from 1,000 times 12% divided by 2, and the end is 30 from 15 times 2 because it's semi-annual. So from the result, we see from the financial calculator, it's 5.019%. Since it's semi-annual, so we can multiply it by 2, hence the annual rate is around 10%. And next, question C.
Thank you, Al. Move to the question C. Question C1. What is the firm's cost of preferred stock? So the formula is RP equal to DP divided by PP, where RP is cost of preferred stock, DP is annual dividend per share, PP is price of preferred stock. From the formula, we got RP 9%. Question C number 2. Common preferred stock is riskier to investors than its debt, yet the preferred yield to investor is lower than the yield to maturity on debt. Does this suggest that you have made a mistake? Our answer is no, since the yield to maturity on the bonds is before tax. Both rates should be after tax to properly compare. The after-tax cost of debt will be 6%. Move to question D. Question D number 1. Why is there a cost associated with retained earnings? So this cost associated with retained earnings refers to the required earning of return or growth of retained earnings. The firm needs to earn the same rate of return on retained earnings as the stockholders could earn on alternative investment of similar risks. In other words, stockholders expect a certain growth rate in the price of the stock of the firm as the firm retains the earnings. That growth rate is the cost associated with retained earnings. The stockholders expect a similar rate of return with the stock in the form of an increase in the price of the stock if the firm withholds earnings. Question D number 2. What is Coleman's estimated cost of common equity using the CAPM approach? So the given was risk-free rate equal to 7%, market risk premium equal to 6%, stock beta equal to 1.2%. The solve using formula RS equal to RFF plus RM minus RRF multiplied by beta. So we got the result 14.2%. For question E will be presented by Rosian.
Thank you, Asri. And then for questions E, cost of common equity using DCF approach, we can solve for the cost of common equity of return earning by using Gordon growth model. So the required return or cost of common equity will be D1 or dividend after one period. It will be divided by P0 or current price per share times constant growth rate. So if we put into the calculation, it will be 13.8%. Next, for the question F. Question F, cost of common equity using bond yield plus risk premium. The formula is RS is bond yield plus risk premium. So it will be 10% plus 4%, which is 14%. And then for the questions G, final estimate of common equity. The answers may vary here. We can take the average of the three approaches to give us the final estimate of cost of common equity, or RS. RS will be CAPM plus DCF plus bond yield plus risk premium divided into 3. So it will be 42% divided 3, which is 14%. Next, for the question H, new common stock has a higher cost than retained earning because of the added cost of issuing such stock. This additional cost is called flotation cost. This will decrease the proceeds from the issuance of new stock and hence will have a higher cost of capital. Retained earning do not have this cost. Next, for the question I to L will be presented by Pak Wisnu.
Okay, for the next question question I. Question is, what are two approaches that can be used to adjust for flotation cost? The first one, we can add flotation cost to a project cost. For example, when we have an initial project cost 100 and flotation cost is 2, then the total project cost will be 102. And the second alternative is increase cost of capital. For example, if the original share issued is 100 and flotation cost 10%, then the real capital raised by company will be 90. Coleman estimates that if it issues new common stock, the flotation cost will be 15%. Coleman incorporates that the flotation cost into the DCF approach. What is the estimated cost of newly issued common stock considering the flotation cost? The formula for cost of equity from new stock will be RE will be D1 divided by P0 times 1 minus F plus G. So the cost of equity from new stock will be 15% as follows. Okay, next for question J. What is common overall or weighted average cost of capital? Ignore the flotation cost. Since we know that the weighted average of the debt is 30%, for the preferred stock 10%, and from the common equity is 60%, then we times the each cost of debt, cost of preferred stock, and cost of the common equity with the weighted average. So we will have the weighted average cost of capital total will be 11.22%. Okay, next. So, what factors influence Coleman Composite working average weighted average cost of capital? We can see at the page 421. One, factors that firm cannot control. A, interest rates in the economy. B, the general level of stock prices. And C, the tax rate. And then the second one, factors that the firm can control. The A, by changing its capital structure. B, by changing its dividend payout ratio. And C, by altering its capital budgeting decision rules to accept projects with more or less risk than projects previously undertaken. So, question L, should the company use the composite weighted average cost of capital as the hurdle rate for each of its projects? We can see in the page 424, the answer is no. Each project's hurdle rate should reflect the risk of the project, not the risk associated with the firm's average project as reflected in its composite working weighted average cost of capital. In general, failing to use the right hurdle rate would lead the firm to accept too many risky projects and reject too many safe ones. Okay, that's all our presentation. Thank you.